Hi, ladies and gentlemen, and welcome back to another podcast with Axis Mutual Fund. I'm your host, Siddhant. We were going through some data internally, and one of these new products that we're going to talk about today, a very interesting data point comes across. So for most of us, the Nifty 50 is the bellwether for Indian markets. But did you know, if you would have invested 1 lakh rupees in the Nifty 50, it would have grown to about 36 lakh rupees by 2026. This is data starting from about May 1995. However, if you would have invested the same 1 lakh rupees in the Nifty 50 equal weight index, it would have grown to almost 56 lakh rupees in the same period. Yes, that's an astounding 20 lakhs additional. And that's something that got me out of bed today to come back and have this discussion with Mahavir. So, with me today is Mahavir. He heads passive research for Axis Mutual Fund and has about 20 years of experience. He's worked with the indices, worked with other AMCs, etc., and is leading the charge for our research. So a lot of the communication that you see from us, a lot of the videos you see from us, product notes, etc., it's all powered by him. Without further ado, welcome Mahavir, and I'm going to trouble you a lot today.
Thank you, Siddhant, for having me. It's going to be exciting, I'm sure.
For sure. So Mahavir, off the bat, like I mentioned in my opening remarks, the Nifty 50 equal weight has given almost 20 lakhs additional. Why? And what is this? What is an equal weight strategy?
I think for this, if you look at the Nifty 50 index, the benchmarking that we have always tracked the market, this index has been there in the market for so many decades, right? The live history is more than 30 years available. All our parents, grandparents probably has been seeing that index, and we probably are also still following the same index, has been there in the market, and that index generally follow a market cap weighted methodology. What we have done in the Nifty 50 equal weight is basically we kind of try to remove the skewness in technical terms, and in simple terms, the bias towards the larger company in terms of the weight allocation has been removed, and every company in this index is given equal weight. Now with this, what has happened is that because a smaller company, which generally tend to have more potential to contribute to the performance of the overall portfolio, has got higher weight in the index. Now as example, if you look at the largest company in Nifty 50, the largest company is about 11% of the weight, as compared to the smaller company, which is just 0.4% weight. I'm talking about the latest data that is available, and that is 24 times difference between the two companies in the same portfolio. In the equal weight index, what we have done is all companies, the largest company to a smallest company, everyone is having the same weight, which is 2% each, being the 50 stocks portfolio. So this has resulted into companies which has done better and they have smaller weight in the index. They were having a better opportunity to contribute the return of the overall portfolio. And in longer term, when the market is trending upwards, we have always seen that mid and small generally tend to do well. Similarly, the smaller companies compared to the larger or the mega companies can potentially add more value, and that is what we have seen in the performance difference that you just talked about.
That's amazing. So Mahavir, fundamentally, let's understand, right? While you've explained what an equal weight index is or an equal weight strategy is, why Nifty 50? We could have applied this on the Nifty 100 or even the 500 or the Nifty 1000. Why did we choose the Nifty 50?
That's one of the most important questions that actually also we discussed before even identifying this product completely. Now, if you look at the broader index, the index Nifty 100 is one of the best index to invest into large cap segment. Nifty 500 is one of the best index to invest into a broader market, which include large, mid, small, and they're perfect to invest into it. But the reason we chose Nifty 50 as an equal weight is because, of course, Nifty 50 is one of the most oldest track index that we just spoke about. But on top of it also, if you look at the skewness of the weights that we just spoke about, 24 times different in the largest and smallest company, is seen in the Nifty 50. And as you expand the universe from 50 to 100 to 500, the skewness narrows down. Right. So the real benefit of diversification can be achieved through Nifty 50. Hence, Nifty 50 is what we chose.
Fair. So let's dig deeper there. Why is the Nifty 50 the default index for India? Like, जैसे कहते हैं कि for example, if you have to take vegetables, it has to be from this vendor. Yeah. Fruit इससे होना चाहिए. Yeah, like as a child, you say if you want a cricket bat, it has to be this brand. A tire for your car has to be this brand. Yeah. So why is Nifty 50 synonymous with India?
Perfect. That's a very good analogy to try to use. And if I do just explain, Nifty 50, for any index to become a bellwether, one of the most important characteristics has to be the most highest liquidity of the underlying constituents. Apart from that, it has to have good representation of the overall market. A narrow index, which is let's say a 5 or 10, 15 stock index, may not have an ability to cover the broadest Indian market. Now with Nifty 50, if you look at entire history, on an average, Nifty 50 has covered with just 50 stocks, covered more than 50% of the India's market cap. So you know, right? Nifty 50 has just 50 stocks, and Indian market almost has 5,000 stocks listed.
Right.
Now with just 50 stocks, if you are covering the almost 50% of India's market, I think that's something the best way to get the market a pulse whenever the market is moving up or down. Nifty 50 has been there to all the bulls and bear runs.
Right.
Like if I'm talking about my childhood, when the IT boom and bust happened, since then to financial crisis, to paper tantrum, the recent COVID crisis, and the recent was the geopolitical crisis as well. All these situations has been very well covered by Nifty 50. And that really help investors to understand what's happening in the Indian market, and hence the Nifty 50 has become what we talk about today. Just to, before I miss out of the point of the liquidity, right? If you look at the liquidity of underlying stocks, they're immensely liquid. All the constituents of Nifty 50 are also part of future and options contract as well. That just add up to the more liquidity of the overall constituents as well. And without forgetting another point, which is Nifty 50 is not just popular in India, but also is popular very much in globally.
Right.
It has a lot of index funds and ETF tracked in global market,
right.
and not just that, but also derivative contracts are also traded in global markets as well. So it's very natural choice for us as well as for the Indian markets to believe that Nifty 50 is one of the index to go for.
Right. I think, Marvin, what you're saying is quite valuable for sure, but I also feel there is a myth here, right? Traditionally, when someone invests in the Nifty 50, they would think that, okay, I am investing equally in all 50 companies across India. And like Mahavir mentioned, there is a definite skewness, right? Is that really true? Is a general, say, an average Nifty 50, if I invest 100 rupees, am I actually investing equal amounts of money in every stock? Am I owning every stock in that?
Not really. Like if you talk about the broader index, which is Nifty 50 index, no. I mean, like we just briefly spoke about, the money that we get from the investor will be allocated according to the weights of the constituents in the index. But I just want to talk about a bit of a skewness that we spoke about. I don't want to appear that skewness is really negative. That's fair, so because that's how the Indian markets are also. If I take about some global markets, look at the Korean market. The Samsung is one of the largest stock in the entire market,
yes.
And they constitute very high weight in that overall market as well. If you look at US market, we always talked about some technology stocks, the top those FANG stocks as well, right?
Yeah.
They constitute significant portion of the market. So does it really mean that skewness is bad? Probably not. That's more important from a representing the Indian market, and also it's fair for investments as well. But as someone who is saying that okay, it's fine to have the skewness in the broader market, but I'm not looking for that. I want every company to have equal opportunity to contribute to the portfolio return, and maybe then here is the index, which is Nifty 50 equal weight index fund that we're launching now.
Right. So Mahavir, let's shed some more light on the skewness that you mentioned. How does the Nifty 50 compare to the Nifty 50 equal weight? Can you help understand? Maybe if you have any data available, we're happy to look at that also. But traditionally, the Nifty 50 is heavy on financial services,
Correct.
then information technology, and then oil, which is, I think, financials about 25%, oil is about 11%, IT is also about 10-11 odd percent. How does this equate to the equal weights?
Yeah, that's a most important point or differentiator between the Nifty 50 and Nifty 50 equal weight. Before we get to the differentiation, I want to make an important point. In this index, we have exactly same 50 companies that are part of Nifty 50. So when you invest, I'm not making a different portfolio for the investors. I'm having the exactly same list of stocks that will be part of the Nifty 50 index, and so is also equal weight index. What is changing, like you mentioned? Changing the allocations. So the money that I'm receiving, let's say 100 rupees I receive from an investor, 11 rupees approximately will go to the largest company in the index, and what are the 40 paisa will go to the smallest company in the index for a broad-based index, which is Nifty 50 index. Same money, if I get into an equal weight index, all the constituents will get all equal weights based upon the index weights completely. Talking about the diversification particularly, if you look at the constituents, the top 10 stocks in Nifty 50 constitute about 54% of the overall portfolio. That's more than 50% by just 20% of the stocks by count. In equal weight, that directly comes down to 20%. So you diversify significantly, like entire 30%, 34% of the weights is moved away from the top 10 stocks.
Right.
That's a significant change. Not just from the top 10, but also look at the bottom 10 stocks. The bottom 10 stock number, our cumulative weight is about 6.4%. That has gone up to 20%. So basically, increasing the weight of a smaller companies in the index as well. So that's the diversity on stock level.
Right.
Like you mentioned, there is also good diversity benefit is coming in from the sector allocation as well.
Right.
The financials weight is about 35% in Nifty 50. That has come down to 22% in equal weight. That's a significant diversification again, because if something goes wrong with financials today, you have much less at stake now compared to the broad-based index.
Right.
Oil and gas about 11% to about 6%. These are the top largest sector. But even if you look at the bottom sector also, their weight has gone up relatively compared to the what they have in the parent index.
Right.
So the bottom line in Nifty 50 and Nifty 50 equal weight is that you have exposure to the same 50 blue chip companies that are part of Nifty 50, but at the same time you achieve a very high level of diversification to stock weight and to sectoral weight. And thereby essentially you basically may have a better potential of getting returns, which we have seen historically, outperformance by the Nifty 50 equal weight to Nifty 50.
Fair. So Mahfir, let's also maybe take a couple of steps back, right? We were discussing this offline that there has been a definite surge in the growth of passive funds in India, both in terms of Nifty 50, in terms of equal weight strategies, in terms of factors, in terms of number of schemes available, in terms of fund houses making schemes available, in terms of ETFs, etc. What is fundamentally causing this growth? I'll probably take a couple of seconds there. I was reading up about passive funds across the world, and this is traditionally a sign where, say, a market is growing to a level where they now have a certain amount of maturity, where passive funds are also preferred. Where people have burnt their hands with active and they're saying, okay, I'm getting the same 50 companies, like you said, I'm getting blue chips, but I don't have to pay as much in expenses, for example. Is that the only reason why passive funds are growing?
I think if you talk about reasons, simplicity and the low cost definitely are the most important reasons that is fueling the growth. Apart from that, you briefly touch upon cyclicity of the performance of active funds. That is also adding concerns to the investors in terms of their investments. That there are fund houses where they experience outperformance and underperformance cycles, and it becomes very difficult for the investor to navigate that thing. If someone stays long term, it still helps for them to invest in the active funds, but that cyclical experience sometimes makes a lot more stress or anxiety to the investors. But if you since you spoke about growth, I am really excited to tell you that I've been part of this entire journey of the passives in India. Like I started my career in 2007, where the overall AUM was less than 10,000 crores, and market share was even less than 0.5%. It has grown from 10,000 crores to today 15 lakh crores. That's the growth we are looking at it, and the market share has grown from 0.5 to 17 to 18% today. So that's an enormous growth we have seen. There are numerous milestones, but in the entire this growth, Nifty 50 kind of index stood very strong, like almost close to 4.5 lakh, which is almost 30-35% of the overall AUM is alone managed by Nifty 50 index. Right. So that's a significant contribution. That shows the faith of the investor in the Nifty 50. You also spoke about briefly about the equal weight index growth, right? So equal weight is a part of factor family, and the factor in based strategies were only came into limelight from 2019 2020 approximately, where the overall AUM of equal weight was about 100 crores, has grown to almost 10,000 crores. If I'm talking about the exact number, it's 9,800 crores approximately. Okay. So that's almost 90-95% times the growth that we have seen. And particularly into this overall equal weight strategy, there are few numerous strategies that are available in the equal weight, but more importantly in this equal weight gamut, the Nifty 50 is the most largest, and hence I think we are also launching the same thing. It has about 70% market share with almost 6,800 crores of AUM. So definitely there is a huge interest among the investors, among these innovative strategies, differentiated weighing. A lot of young and smart investors are preferring factor-based funds, including equal weight that we're talking about.
Right. So let's get a little more fundamental, right? Why would an Indian investor choose a passive fund? Let me give you an example. Growing up, whenever I would talk to my dad and say, "Papa, ये fund लेना चाहिए क्या? यहाँ पे सिप करनी चाहिए क्या?" Like, यार शर्मा जी को पूछ ले, वो distribute करते हैं, उनको पता है. Everyone has this Sharma ji who gives them advice, right? Is it happening that we as Indian investors are more and more happier to assume Nifty 50 is our Sharma ji, where Nifty 50 jo karega, I'm happy because when India grows, my money will grow. Is that what's happening?
I think to great extent that's true. In my view, Nifty 50, like I said, it's a bellwether, right? So all these companies are there for some reason. They have came across entire struggle of becoming and they have not leader in their own segment, right? These companies tend to be more fundamentally strong. Their earnings, overall earnings to the overall listed corporate earnings is significantly large. So keeping in mind all these things, I think Nifty 50 is definitely a Sharmaji, as you call it,
Yeah.
in my view. But there are, of course, like I said, right, there are smart strategies available, which is you can talk about factors. Equal weight is definitely among them. With the same Nifty 50 composition, if you have the same team working for you but different allocations for the same thing, I think it works really well for the investors as well.
Right. So, Mavi, let's also now look a little deeper into, let's go back to factors, right? We already have 3 factor funds that we've made available. We'll potentially launch the 4th one soon and close that basket also. Let's understand as to what factor funds are. We've again in the past spoken about smart beta as a strategy. It's again rule based, right? You're automating investments. You're selecting one rule. Say for example, I believe in momentum as a style. You may believe in value as a style, right? And that's why different people want different flavors of the market.
Correct.
How does an equal weight strategy fit into that gamut? And who do you think is the right investor to consider
Correct.
an equal weight index?
So to first answer what the factor funds are basically, if you look at the broad-based strategies, they are pure passive funds because they are driven by their allocations in terms of their size. In factors, basically what we try to do is that we don't select stocks just because of size and liquidity, which is normally the norm for the all Nifty 50, 100 and 500s. But in factors, we select the stocks because of their own attributes. You touch upon value, then value, the attribute can be PE, PB. In momentum, the price trend can be an attribute. In quality, some fundamental factors can be an attribute. So there's a different attribute that have been used to select the stocks in the portfolio. These attributes have been basically chosen taking inspiration from the active fund manager, right? So it's a blend of an active fund management and passive fund management. What we try to do is that we take inspiration from active fund manager and try to put their learnings in a rule-based manner.
Right.
Hence, it becomes passive for us.
Right.
So we don't have discretion. Once a company qualifies based on a certain methodology in a factor fund, we don't apply any discretion over there. It will definitely form part of the index given it is qualifying the methodology document. Now coming to the where the equal weight fits into this entire gamut. So there are multiple popular factors that are there in the market. We already have momentum, we have quality, we have value. Like you mentioned, low vol is something we are really hoping to launch in near future. The equal weight forms part of the size as a factor family.
Okay.
Where basically you completely remove the bias of size.
Okay.
The mid small also can be part of the factor, by the way, into size, but the equal weight also is definitely part of the size factor family where the size bias is completely removed and you essentially invest into every company in an equal weight proportion.
Got it. So I think what I understand is yes, there are different flavors, there are different kinds of strategies, and that's how even this comes in. This is one of the filters that's available. Let's go a little more to the grassroots, right? Why does someone choose a Nifty 50? Right? I think back in college when my friends started doing their SIPs, when I had some friends pursuing chartered accountancies, when they said, blue chip mein invest kar, blue chip best hai, India ki best companies hoti hai, etc. And that's where for the first time I heard the word diversification.
Correct.
Right? And it actually, and this is pre-chat GPT, so I actually had to go to Google and do a conventional search, go to Wikipedia, diversification hota kya hai, right? And that's how you got into a Nifty 50. But is a traditional Nifty 50 truly diversified?
See, I mean, like I said, if you are part of a certain market, the diversification will be achieved basis what the market looks like. If you look at some like the Brazil or some market which are more on manufacturing or the minings or metals, they will have a lot of manufacturing and mining companies over there. So the tilt of the allocation will be like that. In India, we have a lot more service orientation. Financial services, IT are dominant here. But within that, we definitely are diversified enough. But there are some skews that we spoke about it, right? Financial services about 35%. The largest stock is about 11%. The smallest stock is 0.4%. That's a very like a long tail probably. Like the bottom companies are less than 1% for sure. Like 0.7 to 0.4 is what I recall as a weights there, right? So there is a bit of a scope to enhance the diversification, and hence I believe that then some strategies which can help to achieve that can be very useful for the investors as well.
So, but is the contra also true? Is there something called over diversification? Like there may also, like I'm just playing devil's advocate. What if there is your portfolio is too watered down and then you neither get the head of the performance nor the tail? Then what happens?
I think it's more for conversation, but if you look at the Nifty 500, in my view, then I mean, since you spoke about, I mean, we have 500 stocks now. In our investment thesis, simply it is said that you should include 30 to 50 companies to achieve the highest diversification. But diversification is not only by the stock count, diversification across sectors, size as well. Now, what Nifty 50 offers is all the key economic sectors of the Indian markets are part of the Nifty 50. Nifty 500 offers you not just key economic sector, but many more industries of industry which are not part of Nifty 50 into this index. Apart from that, also Nifty 500 offers us large, mid, small blend, which is beautiful. So I believe that it's good for the conversation, but practically the diversification can be seen in different lenses, and hence, in my view,
Fair.
Nifty 500 can be also a very good product to invest into.
Fair. Now, I think, I think at the start I mentioned that there is almost a 20 lakh difference in performance
Yeah.
between the Nifty 50 and the Nifty 50 equal weight. Mahavir, can you maybe take us through some data points? How has the Nifty 50 equal weight performed versus the Nifty 50
Right.
or versus other broad benchmarks? So, for the folks watching, we have a product presentations available on the website. You can go to accessmf.com. You will see a banner to get into Access Nifty 50 Equal Weight Index Fund. You will have the product PPT available. You will have videos, one pages, whatever communication you need. You will have all of that on the page. The same thing will be available on YouTube if you want to consume it there, or on different marketplaces. Yes, Mahavir, back to you.
Yeah, so I mean, a lot of interesting numbers to talk about it. Equal weight has outperformed Nifty 50 across different time periods. Maybe 1 year period where the Nifty 50 equal weight has given about close to 6% returns compared to negative 4% return by Nifty 50. To let's say 5 year period where the Nifty 50 equal weight is given about 14.6% return compared to 9.9 by Nifty 50. And even like if I talk about 30 year, the longest possible record that is probably available with us right now, it is 14% CAGR by equal weight index compared to 12.3% by the Nifty 50. What is interesting to note, again, at the cost of repetition, is you have the same constituents. You are not changing the portfolio,
Right.
and you're just achieving by diversification the enhancement in return by 1.5%. That's a significant addition to the compounding. You already spoke about the compounding, right? Someone who had a plan to retire after 30 years, if let's imagine he had invested 1 lakh rupees back in 1995, resulting to 35 lakhs for Nifty 50 and almost 56 lakhs for the equal weight. That's a significant growth or wealth creation for the investors. Now, this entire growth has come with almost similar risk as the Nifty 50, because if I measure risk in terms of standard deviation, it is 13.7% and 13.9% for the Nifty 50 equal weight.
Right.
So the risk has not significantly increased, or is fairly same, if I can call that way. And at the same time, you are enhancing return noticeably and wealth creation thereby.
Right.
So that's something definitely interesting to note.
Mahavir, what about, you mentioned that there is a 30-year track record, right? How have these strategies varied? Has there been outperformance through all 30 years by the Nifty 50 equal weight?
No, so it's practically impossible to have a consistently outperforming strategy. There are periods where the equal weight also has suffered underperformance to Nifty 50. And if I can talk about some reasons for that, it's very obvious, right? When you reduce 34% from top 10 stocks, like if you recall, 54% the total weight of top 10 stocks as of now, and in equal weight we're giving about 20%. When you remove such a large portion from top 10 stocks and give it to smaller companies, there can be a situation where the top 10 companies doing better than the Nifty 50. You would have an experience where equal weight is underperforming the broader index.
Right.
However, to mitigate that risk, I would always encourage investors to stay long term. We have seen 30-year track record, right? All despite some periods of underperformance to Nifty 50, equal weight has managed to outperform Nifty 50, and just simply staying long term, you're not increasing the risk. I think this is a very good, simple recipe to create a good wealth for the investors.
Right. So I think with that, Mahavir, I think I just have a couple of more questions for you, and then we can probably get on. Maybe let's see a few questions that we've already received on YouTube in comments, right? This is a very interesting one. Given the markets have been choppy, we're just seeing the end of the war in the Middle East, which happens nowadays. I think it's become like a running joke, because the war stops in a few days and then restarts and stops. Right, so someone's having a good time there. But how does that translate to our investors? Is this the right time for investors to consider this sort of a strategy?
I think it's one of the most fearful environment right now, right? Last 18 months are not supporting the thesis to invest into equity. Because generally psychologically investors look at recent performance to before they make the investment decisions. But one thing we need to really remember is that if you stay long enough, at any point, even if you enter in the market, you're not going to incur the losses. Like if I'm not wrong, my study says that the investment horizon for 7 years would result into almost zero probability of losses, right? Now coming to the current situation, if you look at, there are some concerns still there. I think we're still yet to see completely closure of a geopolitical situation in the Middle East. At the same time, we're looking at the monsoons, which is probably experiencing El Nino impact. Now, for the last few days, we do see a good monsoon there, but if that El Nino appears, it can have a drought kind of situation or
Right.
a deficit monsoon, deficit rainfall, which may potentially have an impact on the overall agricultural output and inflation as well. So, in the next couple of months, if someone is looking to invest, I think this can be one of the good time for them to invest. By the time the things settle down, things get clearer. Market always look for the future.
Right.
So once they find that the concerns have been priced in the current valuations, I think the market should start looking better for the investors.
Right.
So investing long term can always be a biggest solution for the investors just to navigate these concerning periods as well.
I think you're right, Margaret, because I think that's traditionally been our house views also, right? We're a quality fund house, and traditionally we request our investors to stay invested for the long time, for the longer term, because that's when maybe we discussed when we were discussing some other products that markets may seem very choppy in the short term, but as you zoom out of
Yeah.
and you get a macro view of it, you see the trend starts settling down, and that's where wealth is created.
I think I just want to address, like, this is a behavioral aspect, because index is available on a daily basis, not just daily but on a real time basis. We as investors tend to overanalyze the investments. In my view, we should have a periodic review of investment, and rather than looking at every day and every moment of the market, I think if you just avoid that noise and have a periodic review of investment, I think it just addresses a lot of anxieties of the investors, and an accidental wrong decision can be avoided. Like many times we have seen our friends, particularly I can talk about them, they have exited investment at the worst time.
Yeah.
And they have entered after in a worst time as well.
Yeah.
Funnily, like when the market has rallied so much, then they start building the confidence. Okay, now I should invest into the market,
Yeah.
and then they invest into it. Instead, if they had simply followed a SIP route, it would be very, very powerful. I mean, we haven't spoken of SIP returns, but a simple SIP return of Nifty 50 for 20 years is about 24 lakhs investment. If I assume 10,000 rupees SIP, and with this a simple 11.6% CAGR, the 24 lakh would result into 88 lakhs. Now imagine you are just investing 10,000 rupees a month. This 24 lakh is across the 20-year period, 10,000 rupees SIP, and the investment is valued now 88 lakh. That's for Nifty 50. If you talk about equal weight, it just goes further up. Same 24 lakh of a 10,000 rupees SIP per month was resulted into 1 crore 2 lakh.
Wow.
That's the growth we are seeing at it, right? A simple, and this entire 20-year period, we have seen all the ups and downs, right?
Right.
We have had massive financial crisis.
Right.
We have had COVID crisis where we felt that it's end of the world now. We're all going to die. I mean, just slightly, but that's the situation we have been through, and then we still came out of it. So I believe that we should keep hope, invest regularly. That's the most important thing for the wealth creation.
Fair enough. So with that thought, Mahavir, let's probably look at where do you see this this investment strategy residing in a customer's portfolio. Let's take me for example. I have Nifty 50, which is about say 20% of my portfolio. Would you suggest I add more of Nifty 50 but with an equal weight strategy? Do I consider this as an allocation to my core large cap holding, or do you think this can be more as a satellite play? How do you see this happening?
Yeah, so first of all, congratulations if you are Nifty 50 in your portfolio, because that's the first step to start investing into passives as well. In my view, now, like we've discussed in detail, that Nifty 50 and Nifty 50 equal weight brings in same list of stocks. So I would take a bit of a liberty and recommend that this can still form part of the large cap portfolio, because fundamentally the underlying concepts are exactly same. These companies are very well established. So I would not say that you stop or withdraw money from certain fund, but any large cap allocation that you have, maybe Nifty 50 equal weight can become a part of that portfolio.
Understood. So Mahavir, I think to close, we'll probably just do maybe not rapid fire, but just a quick one-line answer. I would want your one-line responses. What is the one-line definition of equal weight?
I think all are equal opportunity for everybody.
Okay. What is one common misconception for Nifty 50?
It's an average and that you are settling for. That's absolutely wrong.
Okay. What is one risk that all investors should always be cognizant of?
I think bad timing. Timing the market is a big
Yeah, I think
risk.
we should. I think very often people say that, oh, you should wait for the market to fall and then invest. I think no one has been successful in doing that. If that would have been the case, economists would have been the richest people in the world.
Absolutely,
Right?
absolutely, totally agree.
Okay. And final, what is the one line you would tell our investors about the Nifty 50 equal weight index?
I think very simple. This is the same 50 companies, blue chip companies that are part of Nifty 50, part of your portfolio in a most diversified manner. And the return potential based on the historical data can be very encouraging. So I think this is definitely one strategy we should definitely consider into part of your portfolio.
Right. So I think with that, Mahavir, we've come to the end of today's episode. Thank you. You've been incredibly patient in answering all of my questions. For the viewers watching this, our NFO starts on the 3rd of July, ends on the 17th of July. It will be available on accessmf.com. It will also be available across leading marketplaces. You can reach out to us through any of the socials, Facebook, Twitter, Instagram, LinkedIn, YouTube. We're more than happy to address any queries. In fact, this product, you can see a couple of videos also available on YouTube. You should be able to explore, learn anything and everything about this fund. Mahavir is always around, so if you add in your questions on the comment box, we'll ensure they reach Mahavir and we'll reply to you at the earliest. So with that, I think we come to an end for today. Thank you folks for joining in. I am Siddhant again, your host, and we'll see you soon.
Thank you everybody.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.